everyone. Welcome to Sam's Summaries. This episode is a deep dive discussion into Sam Fury's summary of Chapter 4 from the book How to Make Money in Stocks by William O'Neill. It has been created with the help of AI. The chapter is titled Annual Earnings Increases. Look for Big Growth. You can read the original post at samfury.com.
All right, so we're diving into stock investing today.
Okay.
Using William O'Neill's book, How to Make Money in Stocks.
Right.
Specifically, Chapter 4.
Okay.
Annual Earnings Increases.
Yes.
If you're listening to this, you're probably trying to figure out which companies are going to do well in the stock market.
Yeah.
And we're going to find out what O'Neill thinks is the most important thing when you're picking stocks to make sure we don't mess this up.
So O'Neill kicks off the chapter talking about how companies have up and down quarters.
Yeah.
And it's easy to get really excited or bummed out about a single report.
For sure.
So what's the main point he's making there?
I think the main point is don't get too caught up in one good quarter or one bad quarter.
Right.
It's the long-term trends that
Yeah.
we really want to be looking at.
Okay, so look at the long-term trends.
Yes.
That's where you can really see what's going on.
And that's where I think his CAN SLIM acronym comes in.
Yeah.
So for people who haven't heard of this before,
Yeah.
can you just give us a super quick rundown of what that is?
So CAN SLIM is an acronym that William O'Neill developed
Okay.
to identify stocks that are most likely to go up in price.
Okay.
And the A in CAN SLIM stands for annual earnings increases.
And not just like any increase.
No. He wants to see big increases.
Okay.
So at least 25% year over year
Whoa.
for the past 3 years.
25%
Mhm.
every single year
Every single year, yeah.
for 3 years.
Yeah,
That's a pretty high bar.
it is a high bar.
Like, how do you even justify a bar that high?
So what O'Neill found in his research
Okay.
is that this is the level of earnings growth that's really needed to outperform the market.
Okay.
You know, it really suggests a company that has figured some things out.
Right.
They have a strong management team, a solid business model,
Okay.
and they're operating in a market that's also growing.
Okay, so their market is growing, they got a good business model,
Yeah,
and they got the management to make it all work.
that's right.
Okay, that makes sense. So then he seems to be pretty skeptical of analyst predictions.
Yes.
And instead, he wants you to look at the reported earnings. Why is that? I mean, aren't analysts supposed to be the smart people?
Yeah, well, so analysts, they're making predictions.
Yeah.
And predictions can be wrong
Right.
all the time.
Yeah.
So what he emphasizes is looking at the actual numbers,
Okay.
the reported earnings.
It's hard numbers,
Hard numbers, exactly.
not just someone's guess.
Exactly. And analyst opinions, you know, they can be helpful,
Okay.
but you don't want to rely on them too much.
Okay, I see.
It's better to go straight to the source.
Okay, makes sense. Now let's talk about this return on equity thing,
Okay.
or ROE.
Yes.
For those of us who are not finance people,
Right.
what is that? How do you even explain that to someone?
Yeah. So return on equity basically tells us how much profit a company is making with the money that shareholders have invested in it.
Okay.
So like imagine if you had a lemonade stand.
Yeah.
Your parents gave you $5
Okay.
to get it started. And then at the end of the day, you made $10.
Mm-hmm.
So your return on equity would be 100%
Okay.
because you doubled the money that was invested.
Gotcha.
Wow.
So it's not just about making money, it's about making it efficiently.
Exactly. Yeah.
Okay, I see. And O'Neill has a benchmark for this too.
Yeah. He looks for companies with an ROE of at least 20% or higher.
20%. Okay. And then, now, here's something that surprised me. He said that the price-earnings ratio, the PE ratio,
Yes.
it's not that important.
Right.
Why? I thought that was like the first thing you're supposed to look at when you're looking at stocks.
Yeah, that's what a lot of people think.
Right.
But O'Neill says a high PE ratio is not always a bad thing.
Okay.
Sometimes it means that investors are excited about the company's future growth and they're willing to pay more for its shares.
Oh.
What he really focuses on is the percentage increase in earnings,
Okay.
not the ratio itself.
So a high PE ratio might actually be a good sign.
Exactly. Yeah. If the earnings are growing fast enough to justify it.
So if their earnings are going up that much, it makes sense that the price is going to go up too.
Exactly. Yeah. The price is reflecting that potential.
Okay, I see. So basically, just to sum all this up, we've learned that you got to have that consistent earnings growth, like a high ROE, meaning they're efficient,
Mm-hmm.
and then the PE ratio is not the end-all be-all.
Right. It's more about the story behind it.
Exactly. Yeah, so when you're looking at a company,
Yeah.
where do you even start with this?
Well, I would start by looking at the company's earnings history.
Okay.
You want to see, are they consistently increasing their earnings by at least 25% year over year?
Got it.
If they are, then you can dig a little deeper,
Okay.
look at their ROE,
Mm-hmm.
see how efficient they are at generating profits.
Yeah.
And then you can consider the PE ratio in light of all that.
Okay, so look at their earnings first.
Yes, earnings first.
And then go from there.
And then go from there, yeah.
So don't just get caught up in the headlines and the hype. Look at the actual numbers
Exactly. Do your research.
and see if they're actually making money consistently.
Yeah. Are they the real deal?
Yeah, exactly. And I think that's what O'Neill's really getting at here.
Absolutely.
So think about the companies that you're watching
Yeah.
or that you're invested in right now.
Yeah.
Do they measure up?
It's a great question to ask.
This is like a starting point to actually figure out if they're a good company or not.
Absolutely. This is just the beginning.
Yeah, this is like step one.
Yeah.
This was a great deep dive into this stuff. Thanks for listening, everybody.
Thanks, everyone.
We'll catch you next time.
Thanks for tuning in to Sam's Summaries. If you found this episode useful, let us know with a like, follow, and share. Also, if you haven't already, be sure to visit samfury.com to get free access to all of Sam's original summaries. You can also get any of Sam's books and other exclusive content. It's all completely free at samfury.com.